Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 24th of February. It's been a fairly bruising week here and there, certainly in terms of the US. A shortened 4-day trading week because of President's Day did not end quite so well after Walmart, the big US retail giant, posted some rather disappointing results which threw some doubts on the strength of the US consumer, of course, which is central to economic growth in the country. On the other hand, across Asia, there was ongoing optimism that the DeepSeek fiasco of last month may be something of a herald for the fact that Chinese companies will be able to compete with US companies, particularly on the AI front. In terms of the UK, mixed economic signals. Positively, there were some stronger than expected retail sales. On the downside, some earlier unemployment numbers came along with higher wage growth, which obviously could be inflationary. Although in terms of the market, the FTSE 100 continues to go well, and that's been helped along by what has turned out to be a pretty strong banking season in terms of full year results. So in terms of the year-to-date movements, Dow Jones currently up 3.8%, S&P 500 up 4%, Nasdaq is up 3.4%, and the FTSE 100 is up 6%. Turning to next week, there's a couple of high flyers to look out for. Full year numbers from Rolls-Royce, whose share price has risen by 87% over the last year, and indeed by more than 450% over the last 2 years on any number of fronts, not least of which a root and branch reorganisation, which was well received by investors. There's been something of a pop in defence stocks generally over the last week or so, given ongoing geopolitical tensions. And of course, Rolls-Royce, in terms of its engines, is also paid on hours flown. And coming into this part of the season, that's where it starts to get quite a bit of income on its services front. So it's been a good time of late for Rolls-Royce. It'll be interesting to see whether they can continue the momentum. Similarly, full year numbers from British Airways owner, International Consolidated Airlines. These shares are up by 123% over the last year, although to put that into some perspective, they're still around 20% lower than they were pre-pandemic, so not quite regained the damage done that the pandemic brought. And some of that, of course, was the borrowing that it needed to do. That being said, when we last heard from them at the third quarter, net debt in that period had been reduced to about 6.2 billion euros from a previous 9.2 billion euros. So clearly a step in the right direction. Revenues were up by 8%, operating profit by 15%. And it also announced a surprise 350 million euro buyback. So again, this is a company which is currently on a strong flight trajectory. And finally, full year numbers from Ocado. Share price down 43% over the last year. Obviously, this is split into two businesses. On the rather more positive side, it has a joint venture with Marks & Spencer, its retail business, which saw a strong Christmas, not least of which because of the M&S connection. But Ocado is also a very fast-growing grocer at the moment. It's the solutions business, the robotic technology, which has been the thorn in the side for this company. Just frankly, not enough new partnerships being signed given the scale of investment so far. So it will be interesting to see, with the retail and solution businesses at odds, whether the company falls to another loss as a group for the year. Thank you for watching. Have a great week.